Hello and welcome to the BizNews Breakfast Briefing. I'm Lucy Ferreira for BizNews.com. In today's show, we have highlights of an interview with Solidarity Research Institute head Connie Mulder, following President Cyril Ramaphosa's recent announcement of a set of sweeping reforms to get South Africa out of the load-shedding quagmire it's been in for 15 years. Mulder discusses the crux of the president's plan to decentralize power generation and why he's cautiously optimistic. You can find the full interview on BizNews.com. We then have the global news briefing from our partners, the FT in London. First up, it's Alec Hogg on the markets.
Thank you, Lucy. Good morning. It's Wednesday, the 27th of July, and onto the markets. But before you start panicking, it was a case of sell on rumour, buy on fact. Last night was the release after the markets close of both Microsoft and Alphabet results. Alphabet, the holding company of Google. Both of those stocks down, dragging the Nasdaq down and the other indices as well. But in after-hour trade, Microsoft is currently 4% higher. Alphabet is 5% higher. But let's go through the major indices. The S&P 500 closed 1.25% lower last night on Wall Street. The Nasdaq Composite was almost 2% off. Here in South Africa, the JSE All Share Index was 1% stronger, and that was pulled there by resources shares, which had a pretty good run yesterday. Anglo Gold, Anglo Platinum 3% higher, Goldfields, Impala Platinum, Anglo 2% higher. And outside of that, we're seeing some very interesting little runs on second line stocks. Roynet, which was trading at 36 Rand middle of the month, is now at 42 Rand a share. Hulamin, which in May was as high as 5 Rand and came all the way down to 2 Rand 15, starting to lift its head. Maybe this is on the electricity announcement by Cyril Ramaphosa. Hulamin, being an aluminium producer, is of course extremely vulnerable to erratic electricity supply. So if we can get that right, well, maybe this company will be able to get back to its former glory. And then Telkom, which just keeps on running. Mid-month was at 34 Rand a share, now 45 Rand a share. Reason for that is the well-publicized interest from MTN to acquire the former telecommunications monopoly. Outside of that, the Rand down 16 cents against the US dollar yesterday, trading at the moment 16 Rand 90, 15 cents lower against the pound, 20 Rand 37, and 2 cents off against the euro, 17 Rand 15, which tells you that both the pound and the dollar were stronger against the euro. Bitcoin lifted its head last night, up by about 0.33%, $21,152 per Bitcoin. The crude oil price is back at $106.86. That's up about nearly $2.50. And the Geltec basket, which tracks what goes on in Bitcoin the day before, at 382 Rand 55 cents. That's down 7%. Finally, gold, $9 weaker at 1,717. But let's get on to the performance of the US markets ahead of the results that came out from Microsoft and Alphabet, two very big stocks. One of them, Microsoft, which is in the BizNews portfolio, which of course we spoke about yesterday in the premium members only webinar. Well, Microsoft came out with numbers that for the first time since the third quarter of 2016 missed the earnings estimates from Wall Street. Only by 6 cents at $2.23. They also missed, however, by $500 million the revenue estimates of Wall Street. Again, it's on a base of $51.5 billion. So 500 million, not really that big. There was some concerns that the cloud service, Azure, only grew 40% year on year, as against 45%, which analysts had been expecting. And the company itself said that it had been impacted by the strong dollar. In other words, international earnings were a little weaker, or quite a lot weaker, than what they had been in the past because of the strength in the dollar. They also said that there was some problems from the Chinese slowdown and dropping demand for purchases of PCs, which of course affects Microsoft, which sells Microsoft Windows, Microsoft Office, and so on. As far as Alphabet's concerned, this was one that many had been concerned about, given the results that we saw last week from Snap, which it also deals in the online advertising area, even though it's far smaller than Alphabet is there. Well, the revenue growth by Alphabet year on year, because of what's going on in the online advertising area, was at its slowest rate in 2 years. That's what the headlines are all about, up by 13%. However, the market had expected that they wouldn't get their earnings, which they didn't. They were also 6 cents a share below what was anticipated at $1.21. The revenues, however, were virtually what was anticipated by the optimistic Wall Street analysts. That came in at $57.5 billion, $100,000 lower than the consensus forecast. In both cases, both Microsoft and Alphabet, big knocks on the share price, as I said right at the outset, selling on rumour in this case and buying on fact, because those shares are both very strong in the aftermarket, and we can expect a lift in the NASDAQ as a consequence today. NASDAQ has now had 3 losing days, but this will come as good news. One of the other issues that weighed on the market last night was Walmart's profit warning on Monday evening. Recall when that came out, Walmart missed quite badly the results that were expected, and it also warned that things are going to get rougher in future. Walmart's share price was down 7% as a consequence. Amazon, which reports tomorrow, was down by 5%. We also saw some of our other favorites taking a bit of a knock last night. Cloudflare down 8%, Uber 3.5%, Zoom 5%, and so it goes. Well, the big news coming out of Europe is that Russia is cutting its Nord Stream gas supplies into Europe to 20% of what it used to provide previously. This has got the Europeans in a tiz. They're talking about forcing everyone in the EU to reduce their power consumption by 15%. So here in South Africa, where we're starting to look at solutions in Europe, they're having to deal with the crisis that they brought on themselves by becoming too exposed to Russia. I suppose we brought our crisis on by becoming too exposed to Eskom.
And now for Michael Apple's interview with Connie Mulder of the Solidarity Research Institute.
What President Ramaphosa announced is a lot of the suggestions that gets echoed in our research and our plans. The number one thing is we're going to decentralize power generation, and that is the crux of the announcement last night. Allowing Eskom to buy more power from independent power producers, allowing Eskom to buy power from mines and from paper plants who produce excess power. These are things that should have been done a long time ago, but is now finally happening. Then even allowing Eskom to buy power from neighboring countries who produce too much. This is all going to stabilize the grid. What we're glad is in the plan, at least, is the specific announcement of a feed-in tariff for rooftop solar, which is something that we've been advocating for, given Vietnam's situation, that Eskom will be implementing. So if you've got solar panels on your roof, Eskom will be implementing a system where you will be able to sell that power back to them at a certain sort of rate, which would be hopefully a favorable rate. And then just the stabilizing Eskom, which is something that our Executive Council also realized is of critical importance, is stabilizing Eskom specifically through getting more skills. Now, we know Minister Gordon reached out to us regarding the skills that Eskom needs, and we've been in advanced discussions in how to ensure that those the people who are willing to help get into Eskom and go that way. So if we look at the announcement, we're cautiously optimistic, a bit angry that it only happens now, but I think rather take the small wins, which is this is the only way that we're going to solve Eskom. Government has not completely stepped aside for the private sector to just take over the whole sector, but it has largely gotten out of the way in several instances. I think one of the most important things about last night's announcement, and it's an admonishment of the Department of Mineral Resources and Energy, is that all of this will be run out of the presidency, which is basically President Ramaphosa completely superseding his own minister, Minister Mantashe, and realizing that the reason this has not been happening is because everything gets stuck at DMRE, at the Department of Mineral Resources and Energy. And this being run out of the presidency is basically admitting the previous errors and trying to reduce red tape as much as possible. Now, this is good. We would still like this to only be an online registration portal. I don't think NERSA is in a position to do that yet, but we'll keep on applying the pressure. For now, if you're an ordinary South African, the number one thing you can do is you can seriously start considering getting solar the moment those feed-in tariffs are published, because solar will be a much more viable alternative on your rooftop if you can. Additionally, if you've got millions of rands lying around, the 100 megawatt generation limit has been removed. There's no limit anymore. So if you want to build a 1,000 megawatt nuclear power station and you want to spend your capital on that, you can do that now, and then only register with NERSA and get connected to the grid. So it has been open to small scale generation, large scale, small scale generation, and we've also opened the door for some bigger conglomerates, if necessary, to get in and stabilize our electricity grid.
He said he spent the past 10 days canvassing for inputs far and wide, as is his habit. Were you approached for input?
We weren't approached, but I know that through several channels, our research did make it onto his desk, and I don't think we're we're that shocked. We're not President Ramaphosa is shocked at everything, but several of the plans and of the things that he announced could have been just as well a solidarity media conference. It was almost verbatim several of the things that he said. So we're obviously not going to take him on for plagiarism or something in that regard.
Yeah, no, you're happy to share this one.
We're more than happy to share this one if we can get out of the dark. That would be wonderful. Another thing that we still need some more detail on, but I think it has to do with our possible pending litigation against Eskom. We sent Mr. De Ruyter a letter that said, but Eskom should be exempting themselves from black economic empowerment, given the fiscal state, given the crisis that the country is in. It just doesn't make sense if our research is correct, to pay between 27 to 45% more for power than we should. And President Ramaphosa announced that they're seriously looking at the local purchasing requirements for tenders, which hopefully will spill over to Eskom as well. Now, this would relieve a lot of the pressure that IPPs have been feeling is in the regular registration process or the licensing process. NERSA would put extremely onerous demands on you that you need to buy from this amount of black-owned companies, this amount of locally produced, and this would, in most cases, make it almost not financially feasible to do these projects. Removing that requirement should help the IPPs, or should help independent power producers, but we'll be going one step further and saying, but just remove that requirement from Eskom as well. It surely doesn't matter who generates our power. No one benefits from having a small elite group getting tenders and not delivering, rather than having the whole country have power and getting millions of people into jobs.
And now for the FT.
Good morning from the Financial Times. Today is Wednesday, July 27th, and this is your FT News Briefing. Europe's scandal-prone lender, Credit Suisse, is getting a new chief executive. Inflation is forcing consumers to adjust, and consumer goods companies are feeling the pressure. In Argentina, people are desperately swapping their pesos for dollars and finding all kinds of ways to do it.
You send a WhatsApp message to someone, they tip up at your flat with the dollars, or they pop it into an offshore account.
I'm Jess Smith, in for Mark Filipino, and here's the news you need to start your day. Credit Suisse CEO Thomas Gottstein is set to leave the bank. His departure marks the end of one of the most tumultuous periods in the bank's history. It comes at an awkward time, but Credit Suisse has tapped a replacement. Here's the FT's European banking correspondent, Owen Walker.
So Uli Kurner is going to step in as CEO. He is head of the asset management business, and until a couple of years ago was head of the asset management business at arch rival UBS. So he's a Swiss national. He's probably be seen as a safe pair of hands. That was very much Gottstein's calling card, if you like. That was how he was presented. So we'll see if this is more of the same.
So, Owen, was Gottstein's departure a surprise? I mean, he presided over a lot of drama at Credit Suisse.
I suppose if you step back a bit, it's not really a surprise he's going. The timing is very strange because they are currently looking for a new chief financial officer. The chairman has only been in place for just over 6 months. It's an entirely new executive team and a relatively new board as well. Lots of change everywhere. So for the CEO to be going at this point, it just really highlights the desperation and the chaos really going on at Credit Suisse.
So how do you think Gottstein's tenure at Credit Suisse is going to be remembered?
I mean, I think if you're charitable to him, he's a guy who was thrust into this role at a time when his predecessor left under a bit of a cloud. He came in just before when Switzerland entered COVID lockdowns, and then last year just proved to be an absolutely disastrous year for the bank. A succession of scandals, two in particular around Greensill and Archegos, that'll be really his legacy. I think it'd be hard to say he was personally at fault for either of those two. They just happened to come about when he was chief executive. And then a whole slew of historic scandals came to a head under his leadership as well. And partly that's because when he came into the role, he wanted to address a lot of these things, but it did mean that, there was rarely a week went by without very negative headlines around the bank. So his legacy will be the CEO of probably the worst period in the bank's history.
That's the FT's European banking correspondent, Owen Walker. Retail stocks dragged down Wall Street yesterday after the big U.S. retailer Walmart issued its second profit warning in 10 weeks. On top of that, a leading index of U.S. consumer confidence fell for the third month in a row because of higher fuel and food prices. Here's our U.S. business editor, Andrew Edgecliffe-Johnson.
We are seeing a message coming out of a lot of the consumer goods companies and the retailers who stock their products that consumers, particularly those more price-sensitive consumers, are starting to trade down. You're starting to see own brand products do better than some of the more premium branded products. At the same time, the more well-off consumers continue to spend. We also had very strong earnings this week from LVMH, the giant luxury goods group.
Okay, so we have people at the lower end of the income scale who are forced to pull back more, but others are still spending. What's the broad picture right now for U.S. consumer spending?
Up until this week, I would have said that economists are struggling to read the U.S. consumer because we've had such mixed signals from different income brackets. I think the news from Walmart may tip the balance a little towards saying that we are now seeing signs that higher inflation, rising interest rates, which raise the cost of people's mortgages and other loans, are now starting to weigh on consumer demand. The one bright spot of that is that this might make the Fed's job a little easier if it signals that the demand that's been part of driving up prices this year may actually be starting to cool.
Andrew Edgecliffe-Johnson is the FT's U.S. business editor. Thanks, Edge.
Thanks for having me.
Argentina's currency, the peso, is collapsing, and Argentines are flocking to the black market to exchange their pesos for U.S. dollars. It has to do with inflation, the economy, and some political uncertainty. To find out more about what's going on, I'm joined by the FT's Lucinda Elliott. Hi, Lucinda.
Hello there.
Why is there such a scramble to get rid of pesos?
Well, traditionally, Argentines stampede to ditch their pesos when there's a mix of economic uncertainty, high rates of inflation, rising demand for dollars, and therefore rising prices on the black market. And this is what we've seen, this particular run that we've seen in July. Everyone who can in Argentina, from florists to lawyers, are rushing to convert whatever peso savings they have into more trustworthy and stable currencies like the US dollar or even crypto coins, because they fear that the economy is about to get a lot worse before it gets better.
So why are people going to the black market and not to a bank or official foreign exchange?
The reason they go to the black market is because the central bank simply doesn't have dollar reserves to give customers because the country's been cut off from international markets and financing since Argentina defaulted. And that's made it virtually impossible for people to get their hands on dollars in the normal way. You're limited to exchanging up to $200 equivalent a month. And if you go to a bank or a traditional money changer, you'll get that sum at the official exchange rate, which at the moment is less than twice the value of what dollars are really worth day to day. So your options are to either go in person to a traditional quiver, or cave as they're known, which is a rather dingy-looking, unmarked bureau de change office that converts pesos and dollars at more favourable rates. Or what's more common in the digital age is that you send a WhatsApp message to someone who will exchange your money, they tip up at your flat with the dollars, or they pop it into an offshore account.
So it's like a digital black market. But Lucinda, going back to why people are so desperate to get rid of their pesos, I mean, part of it is spiraling inflation, as you reported. But also earlier this month, the economy minister, Martin Guzman, abruptly resigned. Can you explain why that was so destabilizing?
Martin Guzman was considered the last close ally of the president and a figure who gave the current administration some level of credibility. And his exit has basically robbed the government of its only credible minister. And that's when you get this kind of frenzy to sell pesos that might be worth something different tomorrow, what they were yesterday.
What's the broader impact on the economy of all these people selling their pesos?
Well, when everyone starts selling or dumping their pesos, that inevitably means that there are many more circulating and exchanging hands, and that will lead to higher rates of inflation. Economists now forecast that inflation in the month of July, since the finance minister Guzman left, is set to hit a monthly rate of 7%, taking that overall annual figure possibly beyond 90% this year. Unless, of course, the government intervenes in some way, or there are some major reforms announced to try and bring price rises down. Most analysts, however, don't see that happening in the short term, partly because Argentina is about to enter a presidential election year in 2023. So this government will be less willing to hit voters where it hurts, even if it will bring down inflation. In fact, one commentator described to me this weekend over dinner that it's like the Peronist government is driving a car without knowing the destination. They're simply trying not to crash the vehicle. And more it feels like Argentines are bracing themselves for that possible car crash, which sadly they've seen many times before.
That's the FT's Lucinda Elliott in Buenos Aires. Thanks, Lucinda.
Thanks for having me.
Before we go, we'd like to make a correction. Yesterday in our podcast, we stated that the UK left the European Space Agency when actually the UK remains a full member of the ESA, which is a non-EU organization. We regret the error and have removed it from the podcast. You can read more on all these stories at ft.com. This has been your daily FT News Briefing. Make sure you check back tomorrow for the latest business news.
And that's all from the briefing for today. If you enjoyed this episode, please be sure to rate, review, and follow BizNews Radio on Apple Podcasts, Spotify, or wherever you listen. Bye for now.